For over a century, two letters stood as the global gold standard for industrial stability and American innovation. GE. General Electric didn't just participate in the 20th century, it powered it, lit it, and flew it. But beneath the polished surface of a sprawling industrial empire, a different kind of engine was being built, one constructed not of steel and turbines, but of debt and derivatives. Today we deconstruct the industrial mirage, how a relentless pursuit of financial perfection dismantled the most valuable company on earth. To the outside world, GE was the ultimate conglomerate, a fortress of diversified strength. From jet engines to light bulbs if it was essential, GE built it. For decades, investors treated GE stock like a sovereign bond, safe, reliable, and seemingly immune to the laws of gravity. However, the boardroom had initiated a high-stakes gambit. They weren't just selling products, they were selling the illusion of infinite predictable growth. While the industrial core remained the face of the company, the foundation was being hollowed out, replaced by a complex financial superstructure that would eventually become its undoing. The transformation began in the 1980s. The strategy was simple but aggressive: transition GE from a pure-play manufacturer into a financial powerhouse. Under the leadership of Jack Welch, GE Capital was expanded from a humble unit financing washing machines into a global lending behemoth. GE possessed a strategic advantage no bank had: a AAA credit rating tied to its massive industrial assets. This allowed the company to borrow money at incredibly low rates and lend it out at a premium. The boardroom fell in love with the margins. Unlike the messy business of building turbines, which required factories, labor, and years of R&D, financial engineering was clean. It was scalable. Most importantly, it was the magic folder used to smooth out earnings. If the industrial side missed a target, GE Capital would simply sell an asset or close a deal at the 11th hour to fill the gap. Wall Street cheered the consistency, but the strategic focus had fundamentally shifted from making things to moving numbers. By the early 2000s, GE had effectively become a massive, unregulated hedge fund with a manufacturing wing attached to it. GE Capital was now responsible for over 50% of the company's total profits. But this was a shadow bank. Unlike traditional financial institutions, it didn't have a retail deposit base to provide stability. Instead, it relied on the commercial paper market, short-term wholesale loans that needed to be rolled over constantly. The strategic risk was profound, yet masked by complexity. GE Capital was deeply intertwined with the global financial system, holding everything from credit cards and aircraft leases to subprime mortgages and commercial real estate. The boardroom had created a systemic vulnerability. They were using short-term debt to fund long-term illiquid assets. The industrial core, once the company's pride, was now merely a credit rating shield for a highly leveraged financial operation. The data streams show the disconnect. While the predicted value continued its upward trajectory, the underlying operational strength of the manufacturing units was stagnating, starved of the investment being diverted into the financial engine. In 2008, the Mirage evaporated. When the global credit markets froze following the collapse of Lehman Brothers, GE's reliance on short-term commercial paper became a terminal threat. The shadow bank could no longer borrow the money it needed to breathe. In a single stroke, the strategic advantage of the conglomerate model flipped into a liability. The industrial side couldn't save the financial side. In fact, the financial side threatened to drag the entire empire into bankruptcy. GE was forced to seek a $13 billion bailout from Warren Buffett and government guarantees for its debt. The fatal miscalculation was now bare. The boardroom had traded industrial resilience for financial engineering. As the artificial data streams snapped, the reality of the hollowed-out core was revealed. The dark liquid, the accumulated risk of decades, had finally ignited, and the titan was burning from within. The aftermath was a slow, painful dismantling. In 2018, GE suffered the ultimate corporate humiliation. It was removed from the Dow Jones Industrial Average, an index it had been a member of since 1896. The recovery strategy was no longer about growth but survival through amputation. Under the pressure of massive debt and a collapsed share price, the conglomerate model was declared dead. GE began a multi-year process of selling off its icons, its appliance division, its lighting business, and eventually, GE Capital itself. The final move in the Gambit was the ultimate fracture. The company split into three separate independent entities. The sprawling empire that once lit the world was gone, replaced by specialized fragments trying to reclaim the industrial identity their predecessors had traded away. The downfall of General Electric serves as a masterclass in the dangers of strategic drift. It is a stark reminder that financial engineering is a tool, not a foundation. When a boardroom prioritizes the aesthetics of the balance sheet over the innovation of its core products, it doesn't create value, it creates a mirage. GE's tragedy wasn't that it failed to innovate, it was that it chose to innovate in the one area where failure is systemic and absolute. In the boardroom gambit, the most dangerous move is forgetting what you actually build. Join us next time on the Boardroom Gambit as we explore the algorithmic arrogance that cost Zillow billions. If you found this strategic breakdown valuable, like the video, share it with your network, and subscribe for more deep dives into the plays that shape the corporate world.